everybody. Today I'm going to be talking about the financial crisis of 2008 and why it might have been caused. I don't know exactly why it might have been caused, and there were a lot of different factors that led up to it. But there were maybe a couple of main factors that were most important and crucial in the overall crisis, or whatever. So, the first thing to understand is what a mortgage is. A mortgage is essentially a loan, mortgage loan, where you have a lender or a credit union or a banker, usually a commercial bank or something, and what they do is they give you a certain amount of money so that you can buy a house. And what you have to do is you have to pay back that principal loan at some point in time. Let's say if a bank gives you $5,000 to buy this house, you eventually have to pay that $5,000 back in a principal. But along with that, you have to pay interest. You pay interest every single month for for whatever that interest rate is of that loan, and that's how that bank makes profit. And so you pay back, maybe at the end of your loan, you end up paying about like 20% interest of however many months you were in debt for, and that's the end of that loan. And so that's what a mortgage is. A mortgage is essentially a loan, but for a house. And so that's pretty much that. You pay interest on that, and that's what that is. And so the thing is, that's the only part of the mortgage that you or a borrower may see. What a lender does is a lender takes your mortgage debt, while you're still paying off the interest, and what they do is they group it with a bunch of other mortgage loans that they sent out to other people. And they group it into this giant thing. And they pass it off to like government banks or whatever, who pass it off. They pass it off to financial intermediaries. They pass it off to credit rating companies. They pass it off to investment bankers, who sell those off as mortgage bonds or mortgage-backed securities. So they group all of these mortgages into one thing, into mortgage-backed security. And what an investor can do, is you can buy these mortgage-backed securities, and you can receive a rate of return that that initial borrower is paying for that house. So if they're paying 5% interest, you as an investor may end up getting like even 2% interest or something. But you're making a return, you're getting a cash flow from these mortgage-backed securities. And so that's how you can possibly make money off of that. And mortgage-backed securities or mortgage bonds act very much like treasury bonds, savings bonds, and that's just how that works. And eventually it matures, and you get the full thing back. And the reason why people really like these is usually because if a person who is paying off a mortgage ends up defaulting means that they don't pay the mortgage, they usually end up getting their money back, somehow. There's some way. But back in the 2000s, this was not a thing. And so there was mortgage-backed securities, and that was a thing. So that's what that is. Now, the reason, I think, in my opinion, the initial cause for the financial crisis is you have lenders here. They're mortgage lenders, and they lend out mortgages, and that's what they do. And basically how it works is you have a person, and they have a credit score. Credit score is or the number on your credit score, or just your credit score in general, is determined by how well you're able to pay off your debts. A person with a high credit score is most likely going to get a loan with a lower rate of interest because they're certain to pay back their debt, and you want them to come back to you because they pay off their debt. You want them to come back, so you give them a low interest rate. But that's how they get a high credit score. And so those most likely are going to be those people are going to be loaned to. Then there are people who don't pay back their debts. They get a low credit rating. And usually lenders are going to look at people with low credit scores. It depends on who the lender is, and they're going to be like, no. that's a little too risky. Like, giving you a loan is going to be a little bit too risky for me. So I'm not going to do that. So basically, that's how that works. What lenders decided to do in the early 2000s is based on the fallacy that real estate is always gaining value. And because there are always people being born into the world and people growing up, there's going to be less houses because people are moving into them, and real estate is always going to go up in value. And so based on this assumption, lenders decided that need they didn't need to listen to credit scores anymore. Why were lenders not looking at credit scores anymore? Well, they decided because real estate is always gaining value. If the person who is paying the mortgage defaults and does not end up paying off the mortgage, then you can take that house as collateral. Collateral is basically it's basically the thing behind the loan. It's basically the thing that somebody can take if you don't end up paying back your loan. It's an extra, it's a safety measure, you know? What happens is for a real estate collateral is if you don't pay back the mortgage, the loaner will take your house. The creditor will take your house, and they're going to sell it off for however much they want, and then just continue the process. With rising real estate values, the assumption was that if somebody defaulted and did not pay back their loan, then you could take their house and sell that house for a higher price than it was initially bought for because of rising values. And you would just always be able to make a profit. Either way, either that person paid back their interest or paid back the debt, or you just took their house and made a profit off of collateral. And you could always make a profit no matter what the credit score of that person was. That's called subprime loaning, where you loan to people who have no credit score, who have no job, who have horrible debt paybackings, because you'd assume that you could just take the house back and sell it for higher. So you're always going to end up making a profit. So nothing is ever going to not make you a profit. So the lender decides, okay, I'm just going to give loans to anybody. And now this was the main reason, in my opinion, behind the 2008 financial crisis. Because giving money to people who are likely to not pay it back it's not good. It's not a good thing to do, because you're going to end up losing money at some point. Well, how could I lose money with rising home values? Well, something these lenders didn't account for is that home prices or home value could fall, and that you would not be able to make a profit off of collateral. And that's one thing that they didn't account for. And that's just that's the whole thing. And so that comes about later. In the beginning, people were handing out subprime loans to people with low credit scores who were financially irresponsible, and the people who were borrowing that money were buying these giant houses. And because loans were being given out to everybody now, because of this new idea that real estate value is always rising, that means that real estate value significantly increases because everybody's buying homes now, and there's less, houses become more scarce, and so the prices skyrocket. And so everybody was like, holy shit, like housing is so profitable now, and people are starting to flip houses, people are starting to do this, people are starting to do that because they're just making money off of it. And people are starting to rent, and people are starting to do this, people are starting to do that. And because Federal Reserve rates were so low at the time, nobody was paying anything back on their loans. Nobody was paying very much interest on their loan, and so everybody was just like buying shit, and there was just this incredible housing just increase, this real estate bubble that was created because of that. It's because there are people who are spending so much money on houses, but on credit, and but people were buying so many houses, and there was just so much investment, and there was so much speculation going on and house flipping. And because investors were like, okay, it's so profitable, value is increasing, we're going to buy this house and we're going to sell it for a profit later. So everybody was speculating, everybody was buying houses. It created a giant bubble. Now, essentially, the bigger the bubble, the bigger the pop, I guess. And so, over time, people started to realize how risky these loans were, these mortgage-backed securities were. The reason they did not realize how risky, or at least the people who invested in mortgage bonds did not realize that these subprime loans were made of mortgages with low credit score people. Like, the reason they did not realize it, and they realized it later, was because risk was being eliminated. Risk is like price for a security. It's not the price, but it can either be a deterrent, or it can draw you in. It can be like, okay, low risk, you have a better chance of getting your money back and making a profit off of this security. Low risk usually comes with people with high credit scores because they have more of a chance of paying back their loan. And then there's high risk, which comes back for people with low credit scores who have a higher chance of not paying off their loan. But the thing is, in order to make more money, risk was actually just being eliminated completely. There was just this risk pressure, and people were deciding that by removing risk, they would just be able to make all this money. And so what credit rating agencies and investment banks, which are the people who take your security and put a risk rating on that security. They put a price on it, they put a risk rating on the security. What they would do is they would give all of these securities completely, like, no risk. Because if these securities didn't have any risk, then nobody would be making any money. Because investment bankers and credit rating agencies make money off of commissions, off of the sales of securities, and they would not be making any money. And so they gave them all the highest ratings, AAA rating, AAA risk rating, and people bought them. Investors bought them. And more investment banks bought them. That's what they did. They bought them because these are so low risk, and these are completely buyable, and this is great. And we're going to make so much money and so much return off of all this stuff, and it's going to be great. And so another thing that actually added to this whole thing were CDOs. CDOs are big boxes that are filled with mortgage securities, and they're also filled with car securities, corporate securities, all of this other stuff. And so people were just going and speculating more and more on these securities, and they were just taking them to more extremes. And so you were making mortgages, securities, and then you're making securities of securities, and more securities of securities of security, and you're just receiving returns on all of these car payments and all of these home payments, which people were paying off, which were incredibly low because interest was incredibly low, but you were receiving it so much, you're just making all this money. And the reason the bankers had bought all of this was because the credit, the risk rating was so low, and they were like, oh, it's fine. Additionally, there came the addition of the credit default swap, which made it so that you could have insurance for your security, so that you could buy a security and you could pay another random guy a fixed rate over a certain amount of months, who would be able to pay you back if you ended up losing that security, or if somebody ended up defaulting on that security. And so there are just so many ways and so many incentives for buying these securities, and people just did it. Also, because mortgage-backed securities were seen as so profitable, investment banks were taking out giant loans from other banks, borrowing huge amounts of money in order to pay for even more mortgage-backed securities. So there was so much money with incredible leverage ratios being taken out by these investment banks. And they were just incredibly high risk. First of all, the risk was lied about. They were just incredibly high risk, high default boxes that were essentially had no value, but they were being passed around as if they were the greatest things to ever exist. because they just were completely lied about. And so one day, one weird day, the Federal Reserve decided to increase, not even one day, but just over a period of time, Federal Reserve decided to increase interest rates for some whatever reason. And so what happened is because mortgage adjustable mortgage rates follow market interest rates. Interest rates for all these mortgages, for all these subprime dirty mortgages, people with low credit scores, rates started going up. And so the people who had no money in the first place suddenly had to pay shit ton more interest on their payment or their loan. And they were like, oh fuck, like we can't pay that. And so people started just foreclosing their houses all the time, and people were selling, and people were, because nobody could pay this interest that was suddenly had just come about. And so loaners looked at this and they were like, oh shit, because you know what happens when people can't pay their interest, or can't pay the interest for a mortgage. People stop buying mortgages. People stop borrowing. People stop borrowing from lenders because they cannot pay these really high interest rates. And so all this entire bubble of just like people with insanely high credit scores and insanely paybackable people, that half of them just couldn't pay back their mortgages because they had no money in the first place. And so now you were asking for more money from people who barely had it in the first place, who you thought had it, but they didn't. And so people just started just dropping. Like houses started dropping. There's collateral was just like being taken in all the time, and it started to get really bad because you know that if you're suddenly foreclosing all these houses, then the value of the houses are going to go down. And if interest rates increase, the value of the houses are going to go down because nobody wants to pay these rates, and people stop buying mortgages. And so real estate value, which was never supposed to go down, started tumbling because people were panicking and people could not pay these rates. And all these people who were supposed to have really great credit scores and a lot of money could not be able to pay off these giant houses they were buying with these subprime loans. And so there was just this giant crash just everywhere because banks had spent so much money on margin, so much borrowed money on all of these mortgage-backed securities that were false and bad, and they were just losing all of their money because they were owing so much more than they could ever pay. There was no liquidity. Everything was becoming illiquid. Housing prices were tumbling. People were losing all of their homes because they couldn't pay mortgage prices. And then, like, everyone started pulling out of the market, and it was a crisis. And banks couldn't afford to stay open. Many banks closed. Some of the biggest banks on Wall Street had to close. People were losing their jobs. Everybody was losing their job because people had spent so much money, so much borrowed money, speculating on these mortgage-backed securities, and nobody could pay them off anymore because there was no mortgages. You can't pay back. I mean, it's just too difficult. I mean, if you have a mortgage security that's not being paid for, you're not receiving any returns, so you can't pay back anything else. And since the value of this mortgage-backed security, which nobody is buying now because everybody realizes how shitty they are, you cannot sell that, you're not making any money, you're losing money, and you can't pay off short-term debts. And so everybody was going bankrupt. And so all the banks were going bankrupt, everybody was, and there was a giant crisis, and it just reflected all across the world and in America, and it was really, really bad. And that's pretty much the whole gist of it. And so most of it, there were two really big determining factors, and that was just irresponsibility from loaners and irresponsibility from creditors, and credit rating agencies and investment bankers who lied about risk, and people who tried to reduce risk to make more money, and people who thought that real estate would never go down in value, and who never decided to realize that interest rates could go back up again, and that there could be a recession, and nobody just realizes because there's just so much money being made, and everybody was just like, they lost all of it. The bigger the bubble, the bigger the pop, you know? So, that's pretty much the entire thing right there. And it was bad. It was bad. So, yeah. And that's why everybody lost their homes, because they were taking out all these subprime loans that they couldn't afford, and now they lost it, and they're like, oh, why the fuck am I losing my home? Well, because your credit score is shitty anyway. You're not supposed to be living in that home anyway. And it was just all brought back down to reality. It was kind of like a mini Great Depression kind of thing. But I mean, it was bad. So, thank you guys for watching. I know that was a little bit lengthy. I'll try to get better at this in the future.